Alright, so this is a learning objective 6 in chapter 6. So this learning objective focuses on describing variable costing and preparing a contribution margin income statement. So this entire learning objective can be very challenging because many of you guys probably don't want to do financial reporting or things like that after this class. So I will just give you a very brief introduction and also tell you what might be the minimum requirements you have to understand in this learning objective. So first of all, let's talk about so-called absorption costing. Absorption costing is a traditional approach, and you have seen that already in financial accounting class. It's required by the GAAP for external reporting. Assign all manufacturing costs to products and the direct materials, direct labor, variable cost, and fixed cost. So if you take a look at this particular example here, so variable costing is sitting here, and in terms of manufacturing cost per unit, we have direct materials cost per unit $35, and direct labor cost per unit $10, and a variable manufacturing overhead cost per unit $5, and a fixed manufacturing overhead cost per unit, which is $25. So basically, we are looking at manufacturing overhead cost per unit in total $30. And finally, the total cost per unit is $75. So that's what we have here. So the variable costing is not required by the GAAP. Actually, it's disabled by the GAAP for external reporting. So variable costing is only for the internal use. So the big difference here is actually the fixed manufacturing overhead cost per unit. You can see that under the variable costing, no fixed manufacturing overhead is assigned to the product cost. So we exclude the fixed manufacturing overhead in a costing analysis for manufacturing cost per unit. So where this fixed manufacturing overhead cost will go to, I can show you in the next few slides. So let's take a look at the traditional conventional income statement. So basically we are looking at absorption costing still. So keep that in mind. This is still absorption costing, which is sitting here. That's required by the government, the US GAAP. That's for the external reporting. So all the publicly traded company must use this method. So we have the sales revenue 4 million and the CGS 3 million. And you may ask me, hey, how to get $75? Go back to the prior slide. You go to the prior slide, you get $75. You multiply $75 by 40,000 to arrive at CGS. Then you get a gross profit. Then you have operating expenses. And these operating expenses are mainly about marketing, sales, and administrative support, all these things. And total is 380,000. So the operating income is 620,000. Okay, so pretty easy, right? You do the numbers in Excel worksheet. You can replicate all the calculations in a minute. So now let's take a look at the focus of this learning objective called variable costing. So variable costing is different from absorption costing, as I said. So it assigns only variable manufacturing costs to products, including direct materials, direct labor, and the variable manufacturing overhead. You may say, hey, wait a minute, where is the fixed manufacturing overhead? You will not assign fixed manufacturing overhead to products under variable costing method. So the fixed manufacturing overhead cost, the cost entirely will become the period cost and the variable costing method. So this is actually a big change here. So the fixed manufacturing overhead cost is kicked out of this the product cost and join the period cost. This is only for internal management decisions. So therefore from there we can derive so-called contribution margin income statement. So what is contribution margin? Just in case you probably have never seen that. So the contribution margin is we call you have sales. Sales revenue. Sales revenue is minus the total variable cost, and the result is called contribution margin. Very simple. The definition is very simple. You know the sales revenues, you know the total variable cost. Subtraction gives you the contribution margin. So now let's take a look at, for the same company, if I want to use a variable costing, what will I get? What will I get? So this is what's happening here. You have a sales revenue, which is the same 4 million, right? 4 million right there. And then less the variable expenses. You don't have CGS now. You don't have CGS now. This is not traditional, conventional income statement. This is the contribution margin income statement. So under the variable costing system, you can only have contribution margin income statement because it's very there's no way you can get a conventional income statement. So you subtract the variable expenses, including the variable CGS, the variable operating expenses. So you have a 40,000 times 50 from your prior page, which is right here, $50, and you minus this is slide 39. You minus 40,000 times 2, the commission variable cost. So therefore, you have 40,000 times 50, 40,000 times 2. And the variable expenses is kind of tricky there. So we have all the variable expenses sitting here, including the CGS, including operating expenses. So you have 2,080,000. Then the contribution margin is sales revenue minus total variable expenses, including operating expenses and CGS. So the result is 1,920,000. So at this stage, you cannot even compare contribution margin with anything in the conventional income statement because it's orange and apple thing. You can only compare when you come to the operating income, right? But at this stage, you just have to continue because there's no comparison you can practically finish here. So you move on. Then you minus fixed expenses. So next, when you have a contribution margin which is 1,920,000, less the fixed expenses, you have a fixed manufacturing overhead which is 1 million. Okay, how to get this 1 million? You can also go back to the prior slides, the first slide, which is sitting here. You have a fixed manufacturing overhead cost per unit, right? And which is a million divided by 40,000. Actually, that million is fixed manufacturing overhead, and also you have a fixed operating expenses which is 300,000. This 40,000 times $2. That's a variable operating expenses. So when you come to the page here and the fixed operating expense, you have 300,000. So now you go from the 1,920,000 all the way to this. The difference tells you, okay, well, I have 620,000. So you may tell me, hey, it's different, and I don't know how to really figure out this difference. I mean, how different, and what giving me difference. So let me actually put all these two tables together to give you a very good idea in terms of comparison. Okay, the comparison here. Okay, let me copy this absorption costing and put that down next to this we call it variable costing. So if you compare these two methods closely, you can see that in terms of operating income, well, seems like there's no major difference, right? No major difference. Okay, so but the entire structure can be so different. The entire structure can be so different. Okay, so being different. Okay, so this is the first one is called variable costing. Next one is called absorption costing. Absorption costing. So next, I want to talk about reconciling operating income between the two costing systems. So sometimes you do have the difference between the operating incomes that provided by two costing systems, and why you have a difference between them. Okay, if you look at the previous example, you may argue, hey, I don't see any difference. They are the same. Well, the reason is you have sold all the units. You don't have any inventory. You don't have any inventory. You don't have any leftover in your inventory. That's why the operating income is exactly the same. But if you do have the inventory, left, then you will have a difference between the operating income between these two systems. And the difference in operating income is going to be the result of the change in inventory level in units times fixed manufacturing overhead per unit. So this is a difference in operating income. That's the only mathematical formula that you have to pay attention to in this entire learning objective. And well, definitely contribution margin, that's also very important formula you have to know. And after that, you have to know about the difference in operating income and how to do that. And the formula is a change in inventory level times fixed manufacturing overhead per unit. So next, I would like to use the next example to show you how to do the income statement for any company using the variable costing and absorption costing. Okay, so this is the example we have here, and this company manufactures a single product, and that's what we have here. The selling prices is $65 each, and the variable manufacturing cost per unit. We have DM, DL, variable overhead, that's about $35, and variable operating expenses per unit sold $2, and the fixed manufacturing overhead in total for the year is $132,000, and the fixed operating expenses in total for the year is $85,000, and the units manufactured and sold for the year is 12,000 units. So the part A is prepare an income statement for the upcoming year using variable costing. So I'm going to use Excel worksheet to finish this process. I know I have answers in the later slides, but I still prefer, okay, I'm going to walk you through this operating, all the calculations so that you can really enjoy, the interactions in this video lecture. Okay. Alright, so that's about what I have here. So I'm going to look at the variable costing, okay, income statement. Okay, alright. So I have these columns here. So the first I'm going to put the sales revenue, okay, sales revenue. Okay, so what is the sales revenue? Okay, so we have $65, and the units manufactured and sold for the year is 12,000. So therefore, I think all I have to do is multiply 65 by 12k, right? By 12k. Okay, so therefore, sorry. I'm kind of running out of space. That's the problem here. So let me, make that a little bit smaller. Adjust my table here. Alright, so the sales revenue is going to be $65 times 12,000. So we're looking at $780,000. Okay, $780,000. So next, let's because it's a variable costing income statement, so I have to use the variable expenses. Variable expenses. Okay, so variable expenses. Alright, so the variable expenses, there are actually several places you have to pay attention to. One is actually the CGS part, and the next is, I would say, the operating expense. So you have several places that will give you a variable expenses. So I'm going to calculate one by one. In terms of CGS, because of the variable costing, so I have to focus on the variable manufacturing overhead cost. So I have $35 times 12k. So I will multiply $35 times 12,000. Okay, so I get this number. For the operating expenses, if I go to the question, we're looking at a variable operating expenses per unit sold $2. So I multiply $2 by 12k. So I get 24,000. So therefore, my conclusion is in total. Okay, in total I can have the 420,000 plus 24,000. I get 444,000. So right now I can go ahead find my contribution margin, okay, which is a result of subtraction. I use 780,000 minus 444,000, so I get 336,000. That's contribution margin. So next, I'm going to take a look at fixed expenses. Okay, fixed expenses. Okay. So there are two places about fixed expenses. One is a fixed manufacturing overhead, and the second one is a fixed operating expenses. So I'm going to use both of them. Okay, so the first one is fixed MOH. The next one is fixed operating. And these numbers are just a given, so it's pretty easy to get them. One is 132,000. Okay, so next one, let me go here, 85,000. Okay, I got 85,000. Perfect. So therefore, if you look at a total fixed cost, I'm going to add these numbers, 132,000 plus 85,000, I get 217,000. So finally, I can go ahead and find my operating income, which is also one step of subtraction. I can use contribution margin to subtract total fixed expenses. Okay, so I use 336,000 to subtract 217,000 to arrive at my operating income, which is 119,000. So that's the variable costing income statement. So next, we can take a look at the conventional method. Okay, so what is a conventional method? Conventional method actually is relatively simple here. So if you know what I mean here, and I can definitely use the same kind of Excel work to show you. So this is a absorption costing income statement. I want to put a gap here to remind you, this is US GAAP. This is a financial statement you have to provide to the government, to the banks, to the investors. So first, same thing here, sales revenue, right? Sales revenue is $65 times 12K. Okay, everybody knows that, and so the result is the same number. Okay, multiply 65 by 12,000, you get 780,000. Next is the entire CGS. So this CGS, we have to look at the variable part and also the fixed. Okay, for the variable, we have that already, and we are looking at 420,000, correct? Which is the result of 12 times 35. Okay, so if you are not sure, you can replicate the multiplication here. You can multiply $35 times 12,000, and $35 includes variable or direct materials, direct labor, and the variable manufacturing overhead, $35. Okay, so you get 420,000. For the fixed is given. You go back to the question. Originally, it says 132,000. Okay, so the total CGS is you add these numbers, you get 552,000. So after the CGS, I can derive my gross profit. This time the gross profit is, I use 780,000 minus 550,000, I get 228,000. So that's the gross profit. So next one is operating expenses. So for the operating expenses, once again, it's kind of tricky here. You have a variable and you have a fixed. So for the variable part is $2 each. So you multiply $2 by 12,000. So you get 24,000. For the fixed part is given also in the question. I think it's 85,000. If you go back to the question, you will find that number. So therefore, if in terms of operating expenses, I have 109,000 in total. So therefore, I can derive my operating income and absorption costing system, which is the gross profit minus total operating expenses. So I will arrive at 119,000. That's my operating income. All right. So that's about these two methods. And finally, I want to give you some interesting arguments here and why there are two different systems. And especially there are a lot of criticisms of absorption costing. That's why variable costing is very popular for internal research, for internal analysis. So you don't have to know the reason, but try to remember the conclusions. So when inventories increase, absorption costing income is higher than variable cost income. So there is basically incentive sometimes for managers. Okay, so and when the inventories decrease, absorption costing income is lower than variable cost income. So what does that mean? So basically, manager can manipulate this a little bit manager can increase production to increase when the manager increase production, maybe increase production more than what manager needs to sell. So you will have a build up inventory. So that's actually is very, very dangerous, because of, when you have build up inventory and you are going to actually invest a lot of money in your inventory, which actually is very, very not recommended, because if you want to do that, you're locked in the cost of financing. There are a lot of risks because inventory cost is very high. So that's sort of issue here. So managers, for whatever reason, they can increase production to build up inventory to maximize the income, because the more inventory level you have, the more absorption cost income you're going to receive. So if your bonus is tied to absorption cost income, then there's an incentive, there's a motivation, because all you have to do is, okay, I increase my production, I build up inventory to maximize my income. That's all I want. So that's very dangerous. On the other hand, if the manager would like to kind of decrease or defer the taxation payment, maybe absorption costing income is also a good idea, because from certain perspective, if I can decrease my production, I clear my inventory, I can defer my taxation payment, because relatively you have a smaller absorption cost income. So there is always incentive for manager to do either way. So this slide is very interesting. I hope you kind of see the idea and memorize the conclusion. That's all you need to do. So inventory is increased, absorption cost income is higher, then bonus is higher. So thank you for watching this video. That's the end of chapter 6. I hope you have a wonderful week, and I will see you next time. Thank you very much.